Hello, everybody, and welcome back to video number 5 in chapter 12. And when we left off, we were looking at a loss contingency here for a loan guarantee. Now, with an expropriation, the illustration here is that the government has decided to expropriate one of Macklin Manufacturing's plant to build a new airport. The book value of Macklin's assets is $20 million, and the company determines the following. One, it is probable that it will receive $12 million in compensation. And number two, expropriation is imminent. Okay, let's look at the journal entry. The following journal entry is going to be recorded for this expropriation. We're going to have a loss on plant assets here for $8 million here. And we get that by taking the $20 million value that the book value was for $20 million in the prior slide, and subtract out the $12 million that we have a high level of confidence we'll be receiving, difference being $8 million. So Macklin should accrue the estimated loss with a debit to the loss account, which is going to decrease income, as you would know. However, if the estimate of the loss is uncertain and involves a range of values, then the best estimate within the range should be used. If no amount within the range is a better estimate, the minimum amount within the range should be used. All right, loss contingencies here. Number one, litigation, claims, and assessments, by far the most common in my experience. But also sometimes we do guarantee payment from someone else or some other company. And of course, warranty costs. And number three, consideration payable. Those would be for such things as premiums, coupons, etc. So, risks disclosed by companies, and here's Tesla, and it's saying that they could be subject to product liability claims, which could harm their financial condition and liquidity if they were not able to successfully defend or insure against such claims. Activision Blizzard Incorporated, they may be involved in legal proceedings here that could have a negative impact on their business. They could be subject to intellectual property claims by infringing on someone else's intellectual property. The Walt Disney Company, they're saying the success of their business is highly dependent on the existence and maintenance of intellectual property rights in the entertainment products and services that they have created. General Mills Incorporated, they have global health developments and economic uncertainty resulting from the COVID-19 pandemic that could perhaps materially and adversely affect their business, their financial condition, and their results of operations. So, the companies must consider the following factors in determining whether to record a liability with respect to any pending or threatened litigation or actual or possible claims, and maybe even an assessment. One, the time period in which the action occurred. Number two, the probability of an unfavorable outcome. And number three, the ability to make a reasonable estimate of the loss. Is it estimatable? Let's take a look at an illustration here. Assume that an employee files a $1 million lawsuit on November 30, 2025 against Kroger supermarkets for damages suffered when the employee slipped and suffered a serious injury at one of the company's facilities. I had that exact same situation occur when I was in the food business. Kroger's lawyers believe that the company will not lose the lawsuit, putting the probability of future payments at less than 50%, which was in fact the situation in my company. All right, so although a past obligation event has occurred, the injury leading to the filing of the lawsuit, it's not probable Kroger will have to pay any damages. Kroger therefore does not need to record a liability, in this case an accrual. If, on the other hand, Kroger's lawyer determined that it is probable, key word there, that the company will lose the lawsuit and a reasonable amount can be estimated, i.e., it is estimatable, then Kroger should accrue the liability at December 31, 2025. All right, guarantee and warranty costs here. This is a promise made by a seller to a buyer to make good on a deficiency of quantity, quality, or even performance in a product. Companies often provide one of two types of warranties to customers. Number one is going to be the assurance type warranty, and number two is the service type warranty. So let's take a look at those. Here's the assurance type warranty. This warranty of a product meets agreed upon specifications in the contract at the time the product is sold. Here, in number one, it should be expensed in the period the goods are provided or the services are performed. Number two, it should record it as a warranty liability. Let's take a look at an illustration. Candy Machine Company begins production of a new vending machine in July 2025 and sells 100 of these machines for $5,000 cash by year end for a total sales revenue of $500,000. We get that by multiplying the 100 machines times the $5,000 per machine. Each vending machine is under warranty for 1 year. Candy Machinery estimates that based on past experience with similar machines, that the warranty cost will average $200 per unit for a total expected warranty expense of $20,000. That's 100 machines times $200 per unit. Further, as a result of parts replacement and services performed in compliance with machinery warranties, it incurred $4,000 in warranty costs in 2025 and $16,000 in 2026. So if we prepare those journal entries here, number one, we're going to prepare the journal entry to record the sale of the machines and the related warranty costs from July to December 2025. We'll debit cash, $500,000, and credit sales revenue for $500,000. Pretty straightforward there. Number two, now we're going to prepare the journal entry during 2025 to record the payment for warranty costs incurred from July to December 2025. And we are going to debit warranty expense here for $4,000 and credit cash, maybe inventory or accrued payroll, depending on the type of warranty, for $4,000. Okay, then next, we're going to prepare the adjusting entry to record the estimated warranty expense and warranty liability for the expected warranty claims in 2025. And that's going to be we're going to debit warranty expense again for $16,000 and credit this time warranty liability for $16,000. Pretty straightforward there, I think. The balance sheet, therefore, is going to report a warranty liability at $16,000. That's going to represent the $20,000 minus the $4,000. Okay. Okay, and the income statement for 2025 is going to report sales revenue of $500,000 and warranty expense of $20,000. Okay. Number 4, we're going to record the assurance type warranty. We're going to prepare the entry to record the payment for the warranty costs incurred in 2026 related to the 2025 machinery sales. So here we'll debit the warranty liability to eliminate that, and it just so happens it exactly equals the real claims here in terms of cash, inventory, and accrued payroll for $16,000. Okay. At the end of 2026, then, no warranty liability is going to be reported for the machinery sold in 2025. All right, service type warranty here. Warranty that provides additional service beyond the assurance type warranty. We're going to record that as a separate performance obligation. And it's usually going to be recorded in an unearned warranty revenue account. We're going to recognize revenue on a straight line basis over the period the service type warranty is in effect. Okay, very common service type warranty here is for an automobile. And here you purchase a car from Hamlin Auto for $30,000 on January 2nd, 2025. Hamlin estimates the assurance type warranty costs on the automobile to be $700. Hamlin will pay for repairs for the first 36,000 miles, or 3 years, whichever comes first. You also purchase for $900 a service type warranty for an additional 3 years or 36,000 miles. Hamlin incurs warranty costs related to the assurance type warranty of $500 in 2025 and expects costs of $100 in 2026 and 2027. Hamlin records revenue on the service type warranty on a straight line basis. What entries should Hamlin make in 2025 and 2028? First of all, we'll do the journal entry to record the sale of the car. And here we've received $30,900. Part of that's for the car, $30,000. And part of that's for the unearned warranty revenue of $900. Number 2, we're going to prepare the journal entry to record the warranty costs incurred in 2025 from January 2nd all the way to the end of the year. And here our warranty expense, $500, and the cash, inventory, or accrued payroll for $500. Number 3, we're going to prepare the adjusting entry to record the estimated warranty expense and warranty liability for the expected assurance claims. And that's going to be a debit to warranty expense and a credit to warranty liability for $200. That looks like a good place for us to end this video. And when we return, we'll take a look at completing the service type warranties. Until that time, bye for now.